Hello, Woden's Day. Woden's Day, and we'll start with the United States, but it's a picture that represents, most all of these things are things that represent the whole of the OECD, industrialized Western nations, going back to 1940 and its manufacturing sector and the service sector. Manufacturing in red, obviously, and service sector in blue. 1940 to 1960, they ran pretty much the same, but then manufacturing went flat and then dropped off. Service sector has gone on the up and up. We have been servicing ourselves for decades. Another angle at this is the Great Prosperity and the Great Regression, which is 1945, not quite as far back as the last chart, up to the 1980 split-off point in this case. And it was pay rising with productivity in the Great Prosperity. Not too many P's for the microphone, I hope. Where wages and overall compensation grew with the productivity, but since 1980, productivity has gone up and away, and compensation for labour has stayed flat. The money from that productivity has gone to the top management and to shareholders via dividends and things like that. This is the SPX going back to a long way, 1950. And we can see there was a great rising up. When we could even say it started in 1980 with this productivity and labour not getting its fair share. That drove stock prices up till the great crash of 2000, 2001, where then things crashed down, and then they realised, oh no, can't be that bad, got back up again, crashed down again to the 660, and now it's trying to get its way up again, but it seems to be having a bit of a dodgy moment as we speak, and it's going down again. So a lot of pension hope went in. When people weren't getting the pay, they were hoping that their 401k, IRAs and that sort of stuff, pension money, was in the stock exchange, and that was all going to go up nicely, and they were going to get a pretty pension at the end of it. But we can see those three peaks. Since the year 2000, the stock market has gone nowhere. So after it crashed, people had the next lot of hope in their house price, and the S&P Case-Shiller, just, we know it should be intimately this chart up till the 2006 peak, and then that's come down. So the hope from retiring on your house price has gone. This was in today's Financial Times. Gap in US pension plans hits $388 billion. The funding hole in US corporate pensions is now larger than at the height of the financial crisis, according to new analysis by Credit Suisse. A $388 billion gap has opened due to a combination of weak equity markets and falling interest rates, eliminating improvements in the funding of defined benefit pension plans at S&P 500 companies since the end of 2008. The gap leaves pension schemes with assets worth only 77% of their liabilities. And that is 77%, and seemingly going into another recession and great downturn, maybe again in the stock market. A lot of hope is evaporating out there. What we have here, I'll read the writing. Economist Paul Krugman says that fragile banks are no longer what's holding back economic recovery. It's housing and household debt, We already saw that housing prices are dropping again, and yesterday he pointed out that another chart of household debt as a percentage of disposable personal income over time, and we can see where another compensation was made by the workers not getting recompense for their labour. Household debt exploded. I know we all know this, but I thought interesting to put it all together. And now that household debt is trying to fall off and saving is trying to be made, but it's all, I'm afraid, far too late. That debt still exists. There is no hope left in the stock market and no hope left in the housing market. But the debts still exist. Over in Europe, a Deutsche Bank chart gives us net issuance of bank debt, bringing us up to date now in Europe, but it, again, this is pretty much across the OECD. We can see 2005, 6 and 7 issuance was well up at €1 trillion, this would be in this case, and redemptions down low, making net issuance over €500 billion. Would that be right? Anyway, we see the direction of it all. It came down and down in 2008 at the height of the crisis, and when it went to 86 in 2009, everyone thought it was going to explode up again and we would be saved as people took on more debt. But they haven't, and it's come down and now is running negative again. And I know we don't like debt, but it is a wonderful driver of growth, GDP, the economy. It's a false driver, but it does drive those numbers up temporarily. And this is markets service sector PMI for the United Kingdom, again representing OECD. The big now service sector is slower to react than the manufacturing sector. We know that the manufacturing sector PMIs are down below 50 and crashing down. Service sector is now starting to follow. Fall in headline business activity index joint second steepest in survey history. Slowdown reflects a weaker trend in new business and general economic uncertainty. Confidence hits 12 months low. And as money stops circulating, we stop servicing each other. And it all contracts, and then everybody looks round for somebody to get it all going again, and always look towards the government. And what they're expected to do, I don't know. I'll leave you with this cartoon, number 9, which I thought was really quite good. Obama's going to speak on Thursday, meant to save the world. Can't possibly. Because, well, he could, with huge ideas and huge honesty and huge backup from what's meant to be the opposition parties. If they got their shit together, maybe they could do something, but they won't. And I'll just leave that last cartoon. Well, it's not a cartoon, it's a photograph that's meant to be amusing. Is there any hope out there? I don't see much. See you tomorrow.